Welcome to The Explainer. I absolutely love tearing apart a balance sheet to find the truth. And today, we're diving deep into the numbers to see how legendary investors would evaluate one of the market's most popular companies. We are putting Accenture, ticker symbol ACN, to the test, using their latest Q3 fiscal 2026 and fiscal 2025 financial data. Here's our roadmap for today. We're going to start with a quick company snapshot, then view it through the Buffett, Lynch, and Graham lenses, run a DCF valuation, check out some alternative models, and finally, bring it all together for our verdict. All right, let's kick things off with Section 1, our company snapshot to establish a solid baseline. So before we get into the complex math, let's just look at where we stand right now. Based on the close of May 29th, 2026, Accenture is sitting at exactly $187.07 a share. When you multiply that by their 612.4 million shares outstanding, you get a massive market capitalization of over $114 billion. We are talking about a true large-cap heavyweight here, bringing in roughly $70 billion in annual revenue. Their revenue streams are incredibly diversified too. I mean, in Q3 alone, they raked in $18.7 billion. Breaking that down, that's $5.7 billion from products, $3.8 billion from health and public service, and billions more spread across financial services, CMT, and resources. So yeah, this isn't some one-trick pony. It is a globally entrenched powerhouse in IT consulting and services. Moving right along to Section 2, let's look at this through the Warren Buffett lens. Okay, so what does Buffett look for? He wants a wide economic moat, stellar returns, and manageable debt, right? Well, structurally, Accenture absolutely delivers. They are taking market share at more than 5 times their closest global publicly traded competitors. That is a textbook-wide moat. Add in an outstanding 25% return on equity, and it gets even better. And their debt? Just $5.14 billion in short and long-term debt combined, which honestly is basically pocket change for a company generating this much cash. Now, you know Buffett loves his owner earnings. We can use free cash flow as a proxy here. In fiscal year 25, Accenture pumped out a massive $10.9 billion in free cash flow. That is cold, hard cash left over after all capital expenditures, completely ready to be handed back to shareholders or reinvested into the business. So here is the million-dollar question. The company definitely passes Buffett's strict quality test, but is there a margin of safety at that $187.07 price tag? You know the famous saying, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. We'll nail down his exact trigger price at the end. Section 3. We are putting on the Lynch and Graham lenses now. Let's see how this holds up under some stricter numerical guardrails. Peter Lynch would categorize Accenture as a classic stalwart. You know, a massive, stable company offering consistent but moderate growth. They actually just reported about 3% local currency revenue growth in Q3. Since our data doesn't mention insider buying, we'll just assume a neutral stance there. But with that single-digit growth and a PE ratio around 14 to 15, we're looking at an estimated PEG ratio, that's price to earnings divided by growth, of somewhere between 1.5 and 2.0. To Lynch, anything over 1.0 means you're definitely paying a premium. What about Benjamin Graham, the father of value investing? He has his famous defensive investor checklist. He wants adequate size, a rock-solid financial condition, steady earnings, and a consistent dividend. Honestly, Accenture aces this. It's huge, the balance sheet is basically a fortress. Q3 earnings per share actually grew 9% to $3.80, and they literally just bumped their quarterly dividend up to $1.63. But here is where we get to the math, and Graham is notoriously strict. First, we find the book value per share by taking their $31.89 billion in shareholders' equity and dividing it by those 612.4 million shares. That gives us $52.07. Now plug that, plus their FY25 EPS of $12.93, into Graham's intrinsic value formula, the square root of 22.5 times EPS times book value, and you get an intrinsic value of exactly $123.08. Ouch. When you put that $123 next to the current trading price, the gap is just glaring. At $187.07, there is zero margin of safety for a strict Graham value investor. The market is clearly pricing in a massive premium for Accenture's brand and intangibles, which Graham's old-school formula completely ignores. Let's switch gears to Section 4, the discounted cash flow valuation. We're going pure quantitative now with a DCF model, which is pretty much the gold standard for figuring out what a company's future cash is worth in today's dollars. We'll start with that proven baseline of $10.9 billion in free cash flow. Now, the source docs don't hand us the exact discount rates, so we have to make an educated analyst assumption. We'll use a standard weighted average cost of capital, or WACC, of about 9 to 10%, which makes total sense for a mature consulting firm. Then, we'll tag on a really conservative 2.5% terminal growth rate to match long-term global GDP. Valuation is kind of an art form, which means sensitivity testing is an absolute must. When we run the numbers through a sensitivity table, unless you're assuming an overly optimistic 8% discount rate, the fair value really seems to settle right in that middle zone, somewhere between $135 and $160 a share. So, if we stick to our baseline assumptions of a 9.5% WACC and a 2.5% terminal growth, the DCF points to a fair intrinsic value of right around $155 per share. Okay, Section 5, Alternative Valuation Models. Any good analyst knows you never just trust one model, right? So let's cross-check this with the Dividend Discount Model, or DDM. This one simply values a company based on the present value of its future dividend payments. And it's honestly perfect for Accenture because they have such a highly reliable and growing quarterly payout. Like we saw earlier, they just raised that dividend to $1.63 per share for Q3, which works out to $6.52 annualized. Assuming moderate dividend growth and discounting it back, the DDM puts the stock's value squarely in the $140 to $170 range. And just as a quick sanity check, a comparable multiples model against their industry peers lands right around $165. Notice how consistently these alternative models align with our DCF? That is exactly what we like to see. Finally, Section 6, Synthesis and Final Recommendation. Well, we have officially run the gauntlet. Let's pull it all together. This master table synthesizes our entire analysis. Yes, the business is structurally phenomenal, but virtually every valuation model is screaming that the stock is trading above its fair intrinsic value right now. Graham would demand a massive margin of safety, dragging his trigger buy price down to around $85. Our DCF and DDM point to a buy price near $130 if you want a decent cushion. And even Buffett, who's totally fine paying up for quality, would probably hold out for a pullback closer to $150. So, what's the big takeaway for you as an investor? Look, Accenture is an incredible business with a massive moat. I mean, they're returning $8.2 billion to shareholders year to date, making smart cybersecurity acquisitions like Dragos, and somehow still expanding their operating margins. But buying it as an investment today at $187 definitely carries the distinct risk of overvaluation. Based on blending the insights from Buffett, Lynch, Graham, and all our quantitative models, our expert verdict on Accenture at $187.07 is a very solid hold. If you've already got it in your portfolio, you just hold on to this compounding machine. If you don't, you definitely keep it glued to the top of your watch list. But at what price would you finally be ready to pull the trigger? That is the multi-billion-dollar question I'll leave you to ponder today. Thanks for joining me on this explainer, and remember, always keep doing the math.